Hi, I'm David Daughtry with Copperwynd Financial. A couple of weeks ago on a Dave's Talk, we talked about how we were going to have some real economic disaster numbers coming out, and they've actually been worse than I anticipated. In the last 4 weeks, we've had 22 million people that have filed for unemployment insurance. The numbers that we saw from jobs numbers 2 weeks ago were not as bad. The unemployment rate ticked up from 3.5 to 4.4, but that looks back into the early to middle part of March. If you look at those 22 million people, that's going to equate to about a 20% unemployment rate. In the Great Recession, we were at maximum down a 10% unemployment rate. So much, much worse, basically about where you would have seen us back in the Depression. Now, do I think this is going to be a depression? No, I don't. I don't think we're going to get there, because this was not caused by business. It was caused by the government shutting down the economy because of a health issue. Those 22 million unemployed people, that erased 10 years worth of job gains. I mean, it's really dramatic here. But on the flip side of that, you've got the Federal Reserve and the federal government that are pushing trillions of dollars out there. The Federal Reserve has, people said, well, they're using a bazooka. Well, no, not really. They're using a nuclear weapon. Unlimited purchases of treasury bonds, unlimited purchases of mortgage-backed securities, corporate bonds, high-yield bonds, loans, municipal bonds, nearly any place that they can borrow, that they can lend money, they're lending money. And then one of the complaints that we had about the Federal Reserve and the federal government last time in the Great Recession was that they were bailing out Wall Street and not Main Street. Well, they're bailing out both right now, because you've got individuals that are going to get $1,200 stimulus checks. You've got rates going down. People are going to be able to refinance their mortgages a whole lot cheaper. It's going to help their cash flow. You've got support for small businesses, $350 billion of forgivable loans that the federal government is putting out there. So you've got a tremendous amount. In fact, the Federal Reserve's increased their balance sheet by $2 trillion in 6 weeks. It's unprecedented amount. But when you look from the health standpoint, I mean, now we're over 2 million people around the globe, and that's dramatically underreported. I'm sure there's a whole lot more. There may be 2 million in China. You're looking at 130, 140,000 deaths already, even 14,000 just in New York. But we're throwing everything we can at treatments, at vaccines. You're seeing lots of money going there, and trials that would have taken years to get approved are being approved in days and weeks. So I'm thinking that we will come out of something of these trials and the vaccines, but it may take a while. When you look at what the markets are doing, they dropped 30% in 3 weeks. We regained about half of that. Some markets even better than that. The bonds, high yield bonds, corporate bonds, muni bonds that had dropped dramatically have come back and regained a lot of what they lost. Gold continues to be strong because people want the safety of those safe havens. Treasury rates have gone down, which is helping mortgage rates. Mortgage rates are probably 1% lower than they were a year ago, which is going to cause a flood of refinancing, and it will help people's cash flow. I mean, when you really look at people that still have a job, they're probably better off because they're sheltering in place. They're not spending as much money. And when you get back where the economy is open, there's probably going to be a lot of pent-up demand because they will have cash flow. They will have money that they've saved, and if they refinance their house, they're probably going to have ongoing cash flow. So I think overall we're going to be good. It's just going to take a while, and whether it's the next 30 days we open up the economy, the next 60, the longer it goes, the worse it's going to be. But it's going to be a trade-off between health and the economy and the health of the economy. So we've taken risk off stock and bond positions as it went down. We've added it back in as it's gone back up, and we'll continue to monitor it. But I think we've probably seen the worst, and hopefully we'll be able to get back to some normalcy in the near future. Thank you.